The self-employment tax is something that is incurred by all self-employeds. I know we briefly talked about it on day one of our class, and we've talked about it. We'll talk about it in the future or when we get to self-employed individuals. But we're going to talk about it here just to kind of show you how it works. So, all right. So I call it the bane of the self-employed because, like I've said before, I work with small businesses. I don't work with the big multi-million dollar people. I work with people who, a few $1,000s means a lot to them. And so this self-employment tax can be quite the burden for it. Like we've talked about before, when you're an employee, you have 3 taxes taken out of your paycheck. The federal income tax, this is based on your W-4 when you claim, like single and 2 or married and 3 or whatnot. With the new 2020 rules, we don't really do the number part of it. We don't do single and 2 anymore. We do single or we do married. We don't do married and 4, we do married because we've done away with the exemptions. And then Social Security, that's 6.2%, and Medicare is 1.45%. So that equals 7.65%. The Social Security and Medicare equals 7.65%. And your employer matches the Social Security and Medicare portion for a total of 15.3% of each of your paychecks being paid in to Social Security and Medicare on your behalf. When you're self-employed, there's nobody to do that match, so you have to pay both halves, which makes the self-employment tax 15.3%. So a lot of people often get mad when I talk to them about this, about how, oh, it's too expensive to go into business for yourself because you have to pay more taxes. Well, yeah, you do pay a little bit more, but you only pay 7.65% more to be self-employed versus being an employee when your employer matches the 7.65%. But there are some other perks to being self-employed is you get to deduct a lot of expenses. So you might have an overall lower gross income. And so you might pay this 15.3% on less overall income. Okay, and so a couple of other things to note about the self-employment tax is there is no limit on the Medicare component, limit or cap. Medicare doesn't cap out. So if you earn $1 bajillion, you're going to pay 2.9% on the full $1 bajillion. Social Security, on the other part, does have an annual limit. For 2019, it was $132,900. And for 2020, it's probably a little bit, it'd probably look better if I'd look it up for you. So I'm going to go look that up. And you won't even notice that I'm gone because I will cut it out and be right back with that new number. So that limit for 2020 is $137,700. Now you might notice it's getting bigger, so you're paying more tax on it because it doesn't cap out as soon. And you may have heard on the news how Social Security is running into financial problems and things of that nature. And so that's one of the tricks the IRS is usually, and I shouldn't say the IRS, the IRS just enforces rules. Congress makes the rules. But that's one of the tricks Congress is using, is making this number bigger and bigger each year at a faster pace. And so that you'll have to pay more tax. And, with this being an election year, we've heard a lot of talk about making the Social Security cap go away or make it as high as $400,000, something along those natures. So once you reach the cap, you no longer pay that 12.4% for Social Security on your self-employment income. This limit is per taxpayer, not per job. So let's say you have a job and you earn $120,000. Well, they're going to be withholding that 6.2% from your paycheck. And of course, your employer is going to match 6.2% to get this 12.4%. But then if you had a side job where you're working either as a self-employed person, let's say, and you make $50,000 there, well, now you've got a total of $170,000. And that is over this cap. And so you'll pay tax on your side job, your self-employment, up to the cap. And then everything over that is not going to be taxed. Taxed at the Social Security rate. One thing we do see is when you have 2 jobs or multiple jobs, maybe you work one job and earn $100,000 and you have another job as an employee and you make another $100,000 there. Now you've earned $200,000, but each job isn't going to know about the other job. So you're going to overpay your Social Security because they don't know to cap it out because you work somewhere else. Well, that's fine. Let them do that and you'll get it back on your tax return. There is a way to calculate over withholding of Social Security on your tax returns every year. But again, you got to get to this cap. If all of your income together is below this cap, you don't even need to worry about this limit. Self-employment tax is paid on the net income of the business. So this is the big one. You've got to remember this. It's the net income of the business. That's what we want to look at when we're trying to decide what your tax is. And so I tell people all the time, the name of the game is to get this number as low as we possibly can so that you don't have to pay the 15.3%. And we do that by subtracting everything we're entitled to. Remember from like chapter 2, if it's ordinary and necessary and reasonable, we're going to deduct it. And people often ask me, you know, give me a list of things I can deduct from my business. And I tell them there is no magic list, just if it's ordinary and necessary, or, you know, and if it is, did you spend money to help you make that money? If you spent $1 to help you earn this dollar and it's ordinary, necessary, and reasonable, then we're going to deduct it. I don't care what it's for. If you spent some money to help you earn some money and it's ordinary, necessary, and reasonable, we're going to deduct it on your tax return. The name of the game is get your self-employment from get your net income from your self-employment as low as possible so it can save you 15.3%. There's some other things we do to where we don't have to get our net as low, where we are not subject to self-employment tax, basically in the form of an S Corp, which we'll talk about later in this semester, but that can save you 15.3% without having to reduce your net income. And we'll talk about that at another time. All right, so the main thing, I hate when people think that being self-employed is somehow a tax burden to them. One of the reasons it's a tax burden to them is because when you're an employee, you pay your taxes little bites at a time. Every paycheck you get, the IRS and your employer are taking little bites of it out and sending it off to the IRS on your behalf. When you're self-employed, you generally don't do that. Now, you should do that. There's ways we can do that, but a lot of times self-employed people only pay tax once a year. When we file their tax return, I tell them, okay, you owe this much money, and they write a check. And for some people, that is a big burden to them. They can't afford to write a large check at that time. And so then they get to where they're having to work this year to pay last year's taxes. And I tell people time and time again, I said, that is just going to be the death knell of you because you're working this year to pay last year's taxes. You want to work this year to pay this year's taxes. Don't be working this year to pay last year's. Work this year to pay this year's taxes, because if you keep working this year to pay last year's, then when we move into the next year, you're going to be working this year to pay this last year, and you're just never going to get caught up. It's a vicious circle. And if you're not paying it all off within 1 year, now you're working 2 years out to pay this year's taxes, and now you're working 3 years out to pay this year's taxes, and it's just going to eat you up. So planning for your taxes, that's why you got to know that net income. People, they come to me in like October and they'll be like, Joe, I'm worried about my tax problem. I don't know how much tax I'm going to have to pay this year. I'll say, well, what is your net income for the year? And if they go, well, I don't know, well, there's your problem. You got to keep on top of what your net income is. I tell people you should know every month what your net income for that month was, and then multiply that by roughly 30%, let's say, because that's 15% for ordinary income tax and 15.3% for self-employment tax. So if you can look and in July your net income was $100,000, you know you're going to owe about 30 grand on that month. And so what I tell people, I said, look at it every month and then plan on it. If in January you made a $10,000 profit, you know it's going to be about a $3,000 tax bill. But in February, let's say you lost $2,000. Well, now you get to add them together. And so now you have a $1,000 profit, and you know you'll have about a $300 problem. And so I tell people, look at it every month and look at it cumulative so you know where you're at. And then at least once a quarter, at minimum once a quarter, send some money off. If you get to the end of March and you say, well, we have a $30,000 profit, well, you should send $9,000 off to the IRS to pay your taxes. So we're working this year to pay this year's taxes, and that is the best way to go about it. But a lot of people don't do that. So it's not a problem being self-employed. It's only a little bit more expensive, 7.65%, but you get to subtract a lot more stuff when you are self-employed, so that even that is negligible. But planning for your taxes is what kills so many people when they're self-employed. So just plan for your taxes and you'll probably be all right. Next, we're going to talk about nanny taxes, where you get taxed for having a nanny. I'm kidding, that's not really what it's about. But we're going to talk about the nanny tax and a few other little taxes.